Hi, and welcome back. Chapter 11, Capital Budgeting. So we're going to be talking about capital budgeting, which is really an important part of any corporate decision, um, and it has to do with long-term projects. So if I'm going to invest in a long-term project, I'm going to put a lot of money up front into the capital, a lot of capital up front, and then I am going to get a payback over a long period of time. So this applies to any kind of a capital project. If I'm going to build a building, I'm going to invest in the building today, and the building will have a life of 20 or 30 years, so I will get a return on that building over the next 20 to 30 years. If I'm buying a ship, if I'm buying cranes in a port, if I'm building new docks in a port, anything that I'm doing, even if I'm dredging, we're looking at a capital budgeting situation. So all of these things, in order to analyze them, should I do it? Should I buy the new gantry crane? Should I invest in a new ship? Should I build a new building? Should I buy a new machine? Whatever it is that I'm looking at, I have to have a way of knowing whether this is a good thing for me to do. And there are three different approaches that we're going to look at. These are three approaches that are used quite frequently. We're going to talk about their relative merits. The first one is called the payback method. The second one is the net present value method, and the third one is the internal rate of return method. And all of them are attempting to quantify the return that I'm going to get from investing in a long-term asset. So we're going to learn how to do some of these things. We're going to learn what they're used for. Really important for you, even though you're not finance students, it's really important for you to know how these decisions are made. How does management decide whether to invest in some new capital item? Well, one of the methods that's used is this capital budgeting method, and understanding that will help you as you move up in management to understand what it is that you need to do in order to get your projects funded. So the very first place you start is deciding where there's an investment opportunity. We have to have a project before we can analyze it. So what is the investment opportunity or opportunities that are open to the firm? They can come from two different areas. They can come from brand new projects. So we haven't had a factory in Canada, and we're looking at building a factory in Canada. That's a new investment opportunity. The other type of investment is reinvestment in something that already exists. So we have a factory in Kansas, and we're looking at investing in that factory to put in new buildings, new machines, expand it, whatever. We're going to invest in something that already exists. So, and the analysis of both this kinds of investments from a financial standpoint is pretty much the same. The risk factors are different, so we'll talk about that as well. But the analysis process, the mathematical process, if you will, is the same. So what we need in order to analyze any project is how much outflow we're going to have and how much inflow we're going to have, and when those flows are going to take place. So in most investments, there's a significant outflow at the beginning of the investment. So we are building the new factory, we're buying the new ship, we're buying the new gantry crane, whatever it is, there's a big outflow at the time that we make the investment. So that's a negative or a cash outflow at that time. And then hopefully, if we're looking at an investment, we're going to start to see inflows after the initial investment. In both cases, these are net cash outflows and net cash inflows. So as we go forward, we may have our inflows may exceed our outflows, so the net is really what we're interested in. Usually at the beginning, the outflows exceed the inflows. So we need to do that, and to do that, we have to estimate. We have to estimate, for instance, if we were looking at purchasing a new cargo ship, we'd have to estimate what cargo rates will be in the future and how much of our capacity of the ship, how much utilization we can get out of the ship. So those are estimates, and whenever you estimate the future, there's a good chance that you can be incorrect. You can't foresee the future. You can make estimates or educated guesses about what's going to happen in the future, but those can often be wrong, and that's where risk comes in. So we know that our estimates have some chance of being wrong, so we try to assign some kind of a probability to our estimates as to the chance that they're right and the chance that they're wrong. And that's the risk element. And we always want to look at our expected return versus our risk. So this is not a science, it's an art. We're making estimates. We're trying to predict the future because we have to invest today to be ready for the future. And that's a tough thing. And every company, every organization does this. We think this is a good idea to build a new store in Poughkeepsie, New York. And we're a retailer, so we invest in a new store in Poughkeepsie, New York. We've done all our marketing analysis. We've done all our demand analysis. We've looked at the marketplace. We've figured out our costs. We've done all that stuff, and this is what we think will happen. But who knows? You don't know until the future until it gets here. So investments, that's why there's risk with investment. You can't predict the future perfectly. So whatever you do, there's always some risk element. So that's going to affect what you need for a return. Because if there's a higher risk, you're going to want to see a higher potential return. If it's a low risk investment, then you may be willing to accept a lesser return. And then finally, tax effect on investments is a significant driver of investment process. So if there's a 30% tax on the earnings from my investment, then I'm really only going to get 70 cents out of the dollar. I'm going to get 70%. So I need to take that tax effect into account when I'm looking at long-term investments. There's also potential tax benefits from long-term investments. So I invest today, it's a 30-year asset, but maybe I can, for tax purposes, depreciate that asset over a much shorter period of time and accelerate the depreciation, which we've talked about before. And if I do that, then I get tax benefits at the beginning of the life of the asset, and we'll see that benefits at the beginning are significantly more valuable than benefits at the end. So you got to look at the tax effect both on the beneficial side from accelerating depreciation, and we have to look at the tax effects on the less than beneficial side, what my return is going to be reduced by the amount of whatever tax I have to pay. So we're going to look at those three methods. The first one is the payback method, and this is sort of the back of the envelope method. This is the method that many of you probably use intuitively on personal things. You know, I'm going to invest in this and I expect to get my money back in X years. That's the payback method. I had in my early CPA career, I had several clients. One I remember quite well, who was a contractor and a very successful contractor. It was a family. They did sort of heavy construction and had lots of heavy equipment, and they did everything based on the payback method. As long as I paid for my equipment, I was fine. So they owned tons of equipment because they would buy equipment knowing they could pay for it with the job at hand. And then it could sit in the yard and not get used ever again because it was bought specifically for that job. So they did not look at anything beyond how fast I could get my money back. And they were very successful. So, payback is an easy calculation. It's easy to understand. It's very easy to understand for non-financial people. And it gets used quite a bit. I don't necessarily recommend it, but we should learn about it. So I've got a little chart here with 4 different projects, all of which require a $500 investment at the beginning. So if you'll notice in the 1/1/2010 investment there, you've got a $500 investment at that time in each one of the projects. So each project requires the same amount of dollars invested. They, however, return a different amount based each year after that. So the investment takes place in what we call year 0. So at the beginning, and then the returns are at the end of each following year. So this is a convention. You can set up these things differently, but we're doing this on an annual basis. So at the end of year 1 in project 1, the project is going to earn $250. The end of year 1 in project 2, there's no return. End of year 1 in project 3, the project will earn $500. And the end of year 1 in project 4, the project will earn $250. And so forth. So the end of year 2, 12/31/11 is the end of year 2. You have those returns across. The end of year 3, 12/31/12. End of year 4, 12/31/13. You have returns in each of those years, and they're different for each project. So if we have a maximum of $500 available for investment, which project should we choose? Well, a payback method looks at how fast I get my money back. So the total returns here for project 1 and project 2 are the same. They each return a total of $1,000 on my $500 investment. Project 3 returns $550 on my investment. And project 4 returns $1,350 on my investment. So we have a net return, the calculation there of 500, 550, and 850. And then we have our payback. So project 1 pays back the $500 in 2 years. $250 first year, $250 second year. So I have my money back in 2 years. Project 2 takes 3.5 years to pay back. I get nothing in the first 2 years. I get $300, which isn't complete, in year 3. In year 4, I get $700. Project 3 pays back all my money year 1. So this might correlate to my contractor client. Had a project, needed this particular piece of equipment, bought the equipment because he would get paid back in a year. And then he got a small amount in year 2 and then never needed it again. So he returned $550 on his $500 investment, but his payback calculation was a 1-year calculation. So that looks like a really good project. So if I'm using the payback method, that's the project I'm going to choose. I'm going to get my money back faster. And then project 4 returns the most over 4 years, but takes 2.5 years to return my $500. So I get $250 first year, $150 second year. So I've only got $400 back through 2 years, and then I get the rest back during year 3. So 2+ years there. So payback says project 3 is what we ought to do. Does that make the most sense to you intuitively? Is that the best project on the sheet? What do you think intuitively? Is that the one you would do? Because the payback says that's the one you should do, using the payback method. Is it the best method? Well, that's for you as a manager to decide if you're using the payback method. I'm going to argue that maybe there are better methods to look at long-term investments than the payback method. So the weaknesses of the payback method, it ignores what happens after payback. So payback here, if we go back here, this pays back in 2 years, and we don't look at what happens after that. Anything that comes in after that is not part of my calculation. And it doesn't take into account when I get the money, other than that I get it sooner. But when I'm getting paid, it doesn't take that into account. And that's really the problem with the payback method, because money has a time value. Money today is worth more than money in the future. If I offered you $1,000 today, or I said, I'll give you $1,000, I guarantee that you get $1,000 in 5 years, which of those offers would you take? Would you take the $1,000 today, or would you take the same amount of money 5 years from now? My guess is that you'd want the $1,000 today because money has utility, and it's more valuable to you today than it is in the future. So that the time value of money is an important concept. So therefore, when I'm putting money out today, the money that I get back, let's say a year from now or 2 years from now, the money I get back for a year from now is worth more than the money I get back 2 years from now. And we're going to look at two different methods of calculating that time value of money mathematically, and using that calculation to evaluate an investment decision, capital budgeting decision. So the first one we're going to look at is the net present value method, and it determines if a product will make more or less than what we need as a rate of return. So first of all, because there's a desired rate of return, we have to determine the desired rate of return. And once again, this is a subjective thing. So we have to make a decision as to what we need for a rate of return. And in net present value calculations, that's called the hurdle rate. So what do I need for a rate of return called the hurdle rate? And if my project exceeds that rate of return, then it's an acceptable project. It's a project that's worth investing in. So how do I get the hurdle rate? Well, the hurdle rate has a couple of different pieces that we have to take into account. We have to be compensated for the money that we're investing in the project, and that presumably that money has a cost. So either I'm borrowing it or my investors are putting it up for there's some basis of cost, and I have to be compensated for that cost of the money that I'm putting into the project. That's the time value of money. And then there's risk. I think I'm going to make this much, but what's the probability that maybe the freight rates for cargo ships will drop? So all of a sudden I'm making less than I expected. So there's risk involved. Those two things together combine to make the hurdle rate. So base rates of return, what my cost of money is, a lot of industries use WACC, which is weighted average cost of capital, and we've talked about this earlier, as the starting point. So whatever my weighted average cost of capital is, I want to make more than my weighted average cost of capital. So my base rate return would be WACC. That if I can't make what my cost of capital is, I shouldn't be investing in this project. Other companies use marginal cost of capital. And what marginal cost of capital is the cost of the next dollar that I need. So if I have a capital base and I need to borrow additional money or seek additional investment in order to do this project, what's the cost of the next dollar I raise? That's marginal capital. Marginal cost of capital is usually higher than weighted average cost of capital. So the next dollar we acquire in capital is usually more expensive than the dollars we already have. That's in general, not always, but in general. So marginal cost of capital usually results in a slightly higher base rate of return. And then we have to figure out what risk is. So what's the risk factor? I've made my calculations. I've figured out what I expect to return. And what's the risk? I can look at other projects that I've done. Let's say I'm buying a new ship. I've bought ships in the past. I have an idea of how to do this. I have an idea of what I can expect so that I know what my risk factors are. I can go out to experts, investment experts, industry experts, all sorts of different kinds of people, and seek their input into what the risk factor is in my investment. Or I can rely on my experience in other areas of the industry. So if we talked about putting a retail store in Poughkeepsie, I have a lot of industry experience in and opening new retail stores, so I have some basis for determining risk. Any number of ways to determine risk, but those are three of the most common ways. So net present value compares the present value of a project's cash flows, inflows to the project present value of its cash outflows. So the present value is the value today of money I'm going to receive in the future. So we're discounting future inflows back to today's dollars. So if we think about, we'll look at that chart again that we just used for the payback and take a look at how that works. But what I'm going to do is say money that I get 4 years from now needs to be discounted back to its value today. It's worth less today than the nominal value. I'm getting $500 4 years from now. That's not worth getting $500 today. So I'm going to discount it back. Generally speaking, if in net present value calculations, if the present value, today's value of the inflows is greater than the present value of the outflows, then it's a good investment. So I've met my hurdle rate, I've met my risk factor, I've met my cost of capital, then if I exceed that, then it's a good investment. So net present value, same calculations that we looked at before, and I've got the payback calculations in there, but I'm using a 6% hurdle rate in this calculation. So I'm expecting to, I need to earn 6% in order to make this a valuable return. So the returns, the calculation of the returns is 250, 250, 250, and 250. It's $1,000 in returns, but the present value of those returns at a 6% hurdle rate is $866. And I'll show you how to calculate this in Excel a little later. The present value of project 2, where the money is coming in later, is less because I didn't get money in year 1 and year 2. Even though I received in total the same amount of money, the present value of that money was less. Project 3, there's your present value, and project 4 is $1,138.47. I think my picture is probably covering that up. The net present value of that return of the project is the 866 minus the 500. So I put 500 as happening in year 0, so that's present value is the same as the amount. So because I put that in at the beginning, so that's today's dollars. So I put today's dollars in. I'm expecting to get these dollars back over 4 years. So the return above my hurdle rate in this case is $366, $306, $16.20, and $638.47. So net present value tells me that the best project is project 4. And the worst project is the one that Payback picked, which is project 3. Project 3 will return $16.20 above my 6% hurdle rate. Project 4 will return $638.47 above my hurdle rate. I think I can move that out of the way. Move that up there, maybe. So that's kind of the analysis out of net present value. So we're getting a very different answer. So the one that takes 2+ years to pay back is actually the best investment for me. The one that Payback said was the best is actually the worst investment. And these two, which had the same total return, Project 1 is better because the money comes in sooner as opposed to later. So pros, definitely looks at the full project life and considers the time value of money. So it's a more accurate method of measuring investment returns than Payback. It's definitely more difficult to do, not very difficult to do, and we'll show you how to do it in Excel. It's very easy to do in Excel. But it's more difficult to explain to people. And finally, the difficult part is you have to figure out your hurdle rate before you can do any project analysis. So you have to come up with a hurdle rate before you can calculate net present value. So the next method we're going to look at is internal rate of return. And it uses pretty much the same mathematical model as NPV, but rather than starting with a hurdle rate, it just projects the rate of return. So here's what the IRR looks like for each one of these projects. So once again, you've got all the same projects. You've got your net present value of the project at a 6% hurdle, and then IRR actually calculates the rate of return for each one of these projects. So the rate of return for Project 3 is 9%. The rate of return for Project 4 is 44%. The rate of return for Project 2 is 21, and the rate of return for Project 3 is 35. So rather than saying what my hurdle rate is and calculating, now I have an IRR, and I can decide that if it's a 44% return, it's worth investing in, 35% is worth investing in, 21% is marginal, and I don't want to invest in something that's going to return 9%. So that's the different kinds of calculations. I have attached a video after this. I think it's after the questions at the end of this chapter, which will show you how to calculate both NPV and IRR. It's a video prepared by me, and I made lots of mistakes in the video, but I think that's actually a good thing because it shows you all the things that you can potentially do wrong, and I did get it right at the end. So I think it works pretty well, and I would suggest watching it and then trying to do it on Excel, and you will have an assignment also to do both NPV and IRR using Excel at the this week for points. So you're gonna have to do that. Once you've calculated your project from highest to lowest IRR, you're going to choose the projects with the highest IRR, or the ones that at least exceed your weighted average cost of capital and risk. So once again, you need to know what your IRR calculations are. IRR is definitely the most commonly used ranking method for capital projects in the business world today. It's easy to understand for non-financial people. It's easy to calculate, and most companies will establish a minimum return. So sort of like your WACC and risk, your hurdle rate for NPV, they will tell their people within the organization that if the project doesn't earn at least 15%, we're not going to consider it. the internal rate of return is not 15% or greater or 10% or greater, whatever the number is. So this is the method that's used the most commonly in business today, and it's also the one that makes most sense in many ways. So definitely do the video on on IRR, and on NPV and IRR, so that you understand how to do it in Excel, and then you also have to do the assignment. Thanks very much, and I'll talk to you later.